This is JPMorgan Chase, the world's most powerful financial fortress. For over a century, it has stood as the ultimate symbol of American economic stability, guarded by the sharpest minds on Wall Street and billions of dollars in Tier 1 capital. But look closer at the foundation. A massive crack is snaking its way up the golden walls, and it's shaped exactly like the iPhone in your pocket. The giant is stumbling, and it's a warning that the ground beneath us is shifting. Behind the shiny headlines, one figure hit the wire that should stop every investor in their tracks: a 7% drop in quarterly profit. The era of easy banking wins is officially over, and the cracks in the consumer engine are now impossible to ignore. When banks lose, your wallet eventually feels the squeeze through higher fees and tighter credit. But stay with me until the end, because I'll reveal the secret exit big institutional players are using to stay safe while the retail crowd panics. You don't want to miss this. Before we analyze why the fortress is cracking, you need an immediate firewall. In a market where banks are reporting profit drops, your first line of defense is not where you invest, but where you park your liquid cash. Move your savings to a high-yield account today. Don't let the big banks profit from your inertia while they scramble to cover their own losses. It's the easiest win you can take right now to protect your purchasing power. Next, you must kill your variable interest debt. As banks protect their profit margins, they will protect themselves by squeezing you first. Every credit card or personal loan with a floating rate is a ticking time bomb for your cash flow. Implement the debt avalanche. Focus every extra dollar on the highest interest rate first. Watch that mountain crumble. You need to be debt-light and flexible before the economic weather gets any colder and credit becomes even harder to find. Why is this so urgent? Because the macro data shows that the American savings cushion has flattened to dangerous levels. There is no more room for financial errors in 2026 as the cost of living continues to outpace wage growth. The bleeding has stopped for now, but to stay safe in the long run, we need to see exactly why the engine failed. Let's open the hood and look at the hidden mechanism that's draining the bank's profits. Think of a bank like a simple kitchen funnel. They take your deposits at the top, pay you a tiny bit of interest, and pour that money out at the bottom as loans to businesses and homeowners at a much higher rate. But right now, the funnel is leaking. People aren't paying back their loans as fast as they used to, and the spread, the profit the bank makes in the middle, is shrinking. When the funnel leaks, the entire bank starts to lose its pressure. A huge part of JPMorgan's recent headache came from the Apple Card. They took over the program thinking it was a high-tech gold mine, only to find a mountain of defaults from consumers who are struggling to keep up with their digital lifestyles. Now, they are forced to build a wall of cash called loan loss provisions. They are locking billions of dollars in a vault just in case more people stop paying their bills. That's billions of dollars in profit that simply evaporated overnight. History has a way of repeating itself. Back in 2008, a leaking funnel in the housing market led to a global crash. We've seen this movie before, and we know that banking crises don't start with a bang, but with a whisper. When liquidity freezes, even a giant bank looks like a shivering popsicle. They stop lending, they stop trusting the market, and the entire economy turns into a giant ice cube. It's hard to grow your wealth when the system is stuck in the freezer. While retail investors are panicking, the big fish are hunting. U.S. Bancorp just dropped $1 billion to buy BTIG, proving that the smart money is moving toward fee-based revenue and away from risky consumer lending. They are playing for the long term. To track these institutional moves before they hit the news, make sure you're subscribed to Sketching Finance. We simplify the chaos so you can focus on building a legacy. Hit that bell to join our community of smart investors. Knowing the why is important, but it's useless without a plan for what's next. We are standing at a major fork in the road, and your portfolio needs to be ready to pivot in seconds, not months. Let's look through the telescope at our two most likely scenarios. Whether the sun comes out or a storm hits, I'm going to show you exactly how to position your assets for maximum protection and profit. Scenario A is the soft landing. If the labor market stays strong and people keep their jobs, they will eventually pay off their debts. In this world, The 7% profit drop is just a temporary speed bump on the road to recovery. In this case, you want to own quality. Focus on cash-rich, big tech companies that don't need to borrow money from struggling banks. They're the true safe havens when the financial sector is under pressure. Scenario B is the credit crunch. If those cracks in the foundation widen, the golden fortress turns into a house of cards. Banks will stop lending entirely, causing a sudden and painful stop in economic growth and business expansion. If the house falls, you run to safety. Gold and government bonds become the only reliable shelter when the banking system loses its integrity. Protecting your capital becomes much more important than seeking high returns in a collapsing market. The big institutional players are already moving. They are shifting into private credit, essentially becoming the lenders themselves. They are bypassing the banks to get higher yields from high-quality businesses while the retail crowd stays trapped in the banking drama. Smart money is repositioning for a high-interest world. They aren't betting on a bank recovery, they are betting on the survivors who have the most efficient business models and the least amount of exposure to the average consumer's debt. The best safe exit for you right now? 4-week Treasury bills. They are safer than any bank account, completely liquid, and currently earning a yield that beats almost any traditional savings vehicle without the risk of a banking collapse. This strategy keeps your cash ready to buy the dip when the dust finally settles. It's the ultimate patience play that allows you to wait for the perfect opportunity while your money continues to grow safely every month. Let's recap your survival plan. First, audit your cash and move it to high yield. Second, eliminate your variable rate debt immediately. Third, keep your dry powder in short-term T-bills while we watch the banking sector's next move. You are now prepared. You have the knowledge to see the cracks before the fortress falls. By acting now, you are taking control of your financial destiny and ensuring your family's future is secure regardless of the market. Thanks for watching. At Sketching Finance, we believe that clarity is the ultimate edge in a complex market. If you found this lesson valuable, make sure you're part of our community by subscribing today. Don't stop here. The banking crisis is just one piece of the puzzle. You need to see our next analysis immediately to understand the full scope of what's coming to the global markets. If the banks fail and the government is forced to print money to save them, inflation will come back with a vengeance. Is gold your best hedge? Or is it finally Bitcoin's time to take the crown as the ultimate digital store of value? We settle the ultimate debate in our next story. Click the video on your screen right now to see where the smart money is moving for the inflation war of 2026. I'll see you there.